Hello and welcome to the latest in the series of Harbin & Co. Private Company Forums, where we look at valuations of businesses and try to see their impact on the market and on the economy. So we initiated this series just over a year ago when we found there were quite a lot of challenges in the world of private company valuations. And we thought it would be a good time now to take a review of what's been happening in the first half of this year. So as we've said before, unless there's a realistic clearing price for transactions, there's a very good chance that basically momentum in the economy dies, companies suffer, and basically the UK entrepreneurial spirit becomes depressed, and we don't want that to happen. So I'm delighted today to welcome back Doug Lawson, who's the CEO of MarktoMarket. Welcome back, Doug. He's been on our previous forums. And then we have a special guest today, David Little from lawyers Bishop and Sewell. So what I'll do is chat to David in a few minutes, but I think to set the scene, Doug, if I can hand over to you, and then you can basically give us an update on what is happening in transactions and what you're seeing and how you feel maybe about the momentum as well. So thank you very much. Over to you.
Great. Thank you very much, Richard. And as ever, thank you for inviting me onto this. My name's Doug Lawson, and I am the Chief Exec and co-founder of MarktoMarket. MarktoMarket is a data platform, financial data platform. It's used by M&A advisors, valuation professionals, private equity investors, corporate lawyers, and basically anybody that's interested in data, and particularly data in the SME and lower mid-market. That's really where we specialize. And our view is that the better data that you have, the more informed decisions you make, and hopefully that leads to better outcomes. We're very forensic about how we collect data, which is how we can gather data sets at the smaller end of the market, where information tends to be harder to come by. We're based in Edinburgh. We have 32 people, and we're venture capital backed. Now, what I'd like to start with is just a bit of an overview of the UK market and what we're seeing in terms of multiples in the UK market. So what we do on a quarterly basis is we collect deal data from our customers, and we collect data. Our team of analysts collects data on what's been going on in the market. And what we're really looking for are the deal multiples that are being paid in the market. And what we do with all of that information is create indices. We call these indices because what we're trying to do is track how valuations are moving from period to period in different categories of the market. So we slice and dice by deal sizes, by industries, and so on. What we're looking at here is our all-cap index. Now, the big caveat that I always like to make is that whilst what we're trying to do here is offer a guide to how valuations are trending, and we call these indices, these are not indices in the same way that a FTSE index is an index. With a FTSE index, you have the same constituents from period to period. With M&A indices like our indices, you're at the mercy of the transactions that are happening in any specific period. And those are going to be completely different from period to period. But what we hope is that, given the size of our samples, that we get a pretty good indication, because the size of our samples means that we're hopefully going to include lots of a wide variety of deals of different sizes from different sectors. So we get some kind of indication of how the market has been moving. So this chart, what we're looking at here is EBITDA multiples. So EBITDA is obviously a pretty common, EBITDA multiples are obviously a pretty common measure of valuations and how valuations are tracking. This is the last 5 years. The shaded bars are the mean, and the darker bars, turquoise bars, are median multiples. And what we can see here is that in the first half of 2025, the multiple trended down a bit, not enormously, but our sample had a median multiple of 6.2 times EBITDA, enterprise value to EBITDA, versus 6.5 times. Now, the other nuances with deal multiples is that you can base them on upfront consideration, you can base them on total consideration, including deferred or contingent. For consistency, we include any deferred or contingent contingent consideration. So that's going to have an impact of moving multiples up a little bit. If we were to do this without any deferred consideration, these multiples would be a bit lower. But this is comparing apples for apples in the sense that all of these periods will be calculating multiples based on contingent upfront and contingent consideration. And on that basis, the multiple has trended down a bit. The sample is sub 250 million pound companies. So we consider that to be the SME, the lower mid, the mid-market, but we exclude any very big deals, which typically skew these multiples on the upside. So we don't include those. So that's the big picture. That's the mark-to-market all-cap index the last 5 years. If you move further back, you can see, people, I think there's a sort of broad understanding that multiples were very high in 2021, relatively high in 2022. And you can see that from the data here. So multiples trended up in the high 7 times. We recorded 7.9 times in 2021. These started to decline in 2022 and then sort of normalized in 23 versus historic data. If you were to look back before 2021, you would see a picture similar to today. Just slicing this a slightly different way. So this is looking at half-year periods rather than annual periods. So we can see over here, H1 2025, that's the 6.2 times EBITDA multiple. The second half of 24, we recorded 6.6, but the first half of 24, we recorded 6.2. So we're actually in line. H1 2025 was actually in line with H1 2024. The dark blue bars here are revenue multiples, and revenue multiples have been pretty static between those 3 periods. Just a wee bit of context here. So if all other things being equal, you would expect a larger business to exhibit a higher multiple than an identical business that was smaller. And you can see here that actually over the last 5 years, the median size of a transaction within our sample has actually come down quite a bit. So that will have a little bit of an impact, or it should have a bit of an impact on how multiples have moved over the period. 12 million was the median deal size that we recorded in our sample. It doesn't necessarily mean that the median deal size across the market was 12 million pounds. It's just within our sample, the median deal size was 12 million pounds in 21 and 22, and that came back to 7 million in 2023, and it's now down at 6.3 million. So I think it's important to just have that context in mind. Now, it's all very well looking at our headline all-cap index, which is sub 250 million pound deals, and that gives, I hope, a useful indication as to how the market's trending in general. But I think it gets much more interesting when you look under the bonnet a bit and you start to segment your data by deal sizes. So that's what we do here. So we have a number of sub-indices, and those sub-indices are mark-to-market nano-cap index, micro-cap, small-cap, mid-cap, and large-cap index. The nano-cap index is companies that have sold for less than 2.5 million. So you can see that over here, and that was 3.9 times was the median multiple paid for a sub 2.5 million pound company. The next category is 2.5 million to 10 million, 5.6 times. Then we have 10 to 50, 7.3, and 50 to 250, 10 times. Now, we also have this large cap index. This tends to be a bit more volatile because the sample size is much smaller, because you have fewer deals happening above 250 million. So we don't pay too much attention to that, actually. We focus on the other indices. But you can see here that this follows the kind of well understood assumption that multiples will increase as deal size increases. And you can see that quite clearly here as you go from nano cap up to mid cap. Just to look at the trends in those different indices. So this is just looking at the 5-year trend for each of those size indices. So this is nano cap here. It's in line with 2024. Similarly, micro cap, which is 2.5 to 10 million pound deals, broadly in line with 2024 as well. As we move up to the small cap, we see the greatest degree of movement in the small cap. That's moved from 7.7 times to 7.3 times. And then the mid cap was broadly in line as well. If you remember, our all cap index moved from 6.5 times to 6.2 times year on year. And you can see that the biggest impact was in our small cap with small cap deals, which are 10 to 50 million pound transactions using our definition. Okay, so what about the US? So that's the UK picture. What about the US? What we're looking at here is data from the US for the last 3 6-month periods. So we've looked at H1 2025, and then we've compared that with the full year 2024 and the last 2 half years as well. Now, these multiples are much higher, and that's because at the moment when I did this analysis, I wasn't capping deal size. So there are some very, very big transactions included in these samples, and that's going to have the impact of moving multiples, of creating a higher median multiple. And you can see that there. So the median multiple in our sample was 10.8 times EBITDA for a US target business. If we drill down into sectors, so I've just included a few of our, what we call our super sectors here. So we've got consumer, and that will include consumer goods, consumer services, retail, hospitality, and so on. We've got financial services, which will be everything from accountancy to wealth management, insurance, banking, etc. Industrial support services, engineering businesses, business services, cleaning, security, and so on. And then we have TMT, technology, media, and telecom. So what's quite interesting, I think, if you look at H1 25 versus the full year of 2024, bearing in mind that the aggregate multiple trended up a bit in our sample, actually consumer was down a bit, but again, it's not material. Financial services was down a bit, it's not really material. Industrials and support services down, not material. And then TMT was actually up a bit. So it's clearly the TMT deals that are pushing the that aggregate multiple that we were looking at before, this one here, pushing that multiple up a little. And actually the driver within that, when we looked into the TMT sector, TMT stands for, as you'll be aware, technology, media, and telecommunications. And within technology, the largest subsector within technology is software and software as a service. Software as a service tends to command relatively high multiples, depending on size, growth, and other factors. But what we thought it would be interesting to do was just look within TMT and look at how SaaS has been performing. And actually, SaaS has been performing pretty well in the first half of 2025 relative to 2024. So the median EBITDA multiple in our sample increased from just under 20 times to 24 times, and the median revenue multiple, and you often find that SaaS companies, people will refer to a revenue multiple when they're talking about software companies. Our software sample, the multiple increased from 4.4 times to 5.6 times. So a strong performance from SaaS really pushed that TMT multiple up, which in turn pushed up the aggregate multiple, the median multiple for the US market as a whole. And one interesting insight I thought was that there seemed to be the popularity of healthcare SaaS companies was quite prevalent in the first half of the year. So we had a number of kind of lower mid-market, and we kind of define lower mid-market as sort of 10 to 100 million in dollars. And you'll see here a few kind of lower mid-market size businesses in the healthcare software sector sold. So we had iCAD, which was a screening software screening business for malignant soft tissue and calcification for mammograms. Then we had Fabric Genomics. That was 33 million up front, but there was a large deferred element as well. We often see that, and increasingly we're seeing that in deals, a larger proportion of the overall deal value moving into contingent consideration. Then we had a 37.4 million acquisition of Streamline Health Solutions, and then £4.5 million acquisition, plus 2.5 contingent of Secure DX, which is a gene editing safety platform. Fewer deals in this sector in 2024. One we picked out was called In Healthcare, and that was a $19.6 million deal. We can also, I think it's often quite interesting to plot these deal multiples, especially for SaaS, or frankly for any sector, to plot these deal multiples against the deal value. And this is just coming back to what we were looking at before, where we were seeing deal multiples expand as size expands. Of course, it's far more nuanced than that, and there are lots of other factors that will drive a deal multiple higher or lower. Interestingly, looking at these healthcare deals, there isn't really a trend, a clear correlation. It's a small sample. These 5 software healthcare deals, there isn't really a strong correlation between deal size and multiples. That will be because other factors were taken into account, such as growth, for example. So I would expect the growth of in healthcare. I haven't looked too closely at this deal, but I would expect in healthcare to be exhibiting very strong growth to command a multiple of 8.1 times revenue as a $20 million business. So just in summary, multiples suggesting a pretty stable picture for SME valuations in the UK in the first half of 2025 versus 2024. Our all-cap index is trading, if I'm allowed to use that expression, at 6.2 times EV to adjusted EBITDA in H1 2025, which is in line with H1 24, down slightly versus H2 24. The biggest movement was in our small cap index, which is 10 to 50 million pound deals. That fell to 7.3 times versus 7.7 times. In our US data set, multiples crept up, and that was driven by the TMT sector. And within this sector, the real driver was software as a service. Typically, valuations there are quite interest rate sensitive because they are typically higher growth businesses. So if you're looking at future earnings, you're discounting those back at a higher interest rate in an environment where interest rates are rising, and that will reduce your present value. And then within that sample, we saw quite a lot of activity in healthcare software, but overall a reasonably stable picture in H1 2025. Richard, that's probably all I have to say for now.
Doug, thank you very much indeed. And I think the US perspective is also very important. So thank you for that. So now we're going to move over to David Little. And David, before we start, would you just like to say a few words about yourself, about Bishop & Sewell, about the sort of clients you deal with, and then we'll move on to have a discussion about what's actually going on in the market and what trends you're seeing. So can I ask you just to say a few words about yourself? Thank you.
Yes, my name's David Little. I'm head of corporate at Bishop & Sewell Solicitors. We are a central London law firm, small to mid-size. There's 120 of us in total. I'm one of the 7 equity partners. My team, most of our work is M&A related. A few years ago, I think like a lot of firms, we'd have done a lot more corporate finance work, but I think we all know that that listings and the public markets generally are have been quite tough for a number of times. We're not particularly focused on any particular sector. I'd say we're probably sector agnostic. I tend to prefer more of the people businesses, the ones which typically go wrong, the retailers, the restaurants and bars. Well, I've got a business partner who's probably much more capable on the IT related deals, on the TMT sector deals. We are still seeing transactions going through, but at very much the lower end of the market, and this often happens when the sector is quite quiet. The bigger firms are now pitching for business in what I would say is our normal bracket, sort of the typical deals being the 1 million to 7 or 8 million, which would normally be us and several similar sized firms. But now it seems the bigger boys are prepared to pitch, do it at perhaps for them reduced rates because they want to keep their M&A teams in place for as and when there's going to be an upturn.
So in terms of general sort of activity, how busy you are, how broad your client base is, if you were to go back, let's say, 12 months or even to the beginning of this year, are there any trends or changes, or is it sort of business as usual?
I think the smaller end deals are happening, the smaller deals. The larger transactions, probably not, and that's often perhaps down to the buyers not getting the finance, or it's often down to the sellers basically overvaluing the business. We've been fortunate. We've had a decent pipeline. We had a couple of very large transactions in the first part of this year. But if I'm wearing a business development hat, because I do a lot of business development, I'm probably wearing out the shoe leather a lot more than I would have done 12 months ago, trying to bring work in for a rather hungry team.
So I think one of the things, I mean, Doug and I basically come from an accounting background, so we've never had the benefit of being trained up as a lawyer. But it seems to me anyway that a lot of lawyers, they're either doing work for people who or corporates who are thinking way ahead and therefore need to get their legal pathway sorted out. Or the opposite side is you get people panic at the last minute because something's gone wrong and someone says you better talk to your lawyer. So when you talk to your client base at the moment, would you say they're more the former, they're planning ahead? Because if that's the case, you're in a very good position to sort of give insights into what might be happening in Q3, Q4 this year than maybe a lot of other people.
I wish I was that optimistic. I wish we had more clients taking a long-term view. We're definitely more sales side as well, I'd say, over the last 12 months. The ratio of 50-50 has perhaps shifted more 65-35 in favour on the sales side. We're often brought in as well on the sales side quite late on in the day, by the time the heads of terms have been agreed. So then it becomes more of a process for us. But I'm not seeing with the various business people, clients I meet frequently, I'm not yet seeing a rise in optimism. But that's not to say that there might be an uptick shortly. I mean, certainly, obviously, all the economic data is a bit doom and gloom. You guys are the accountants, but what I've known, having been a corporate lawyer for over 30 years, there's always been peaks and troughs. So things move very, very suddenly. And if we had a couple of additional transactions on at the moment, we'd be bursting at the seams. So everything seems a lot more short term. The pipelines look okay for 2 or 3 months, but we're not seeing corporates saying, this is our plan for the next 6-12 months. Can you please help us achieve that? Make sure you've got a team of people in place. That's not typically happening.
So if you were to, you talk about you're more sales orientated, you mean you're basically people who want to sell their businesses or
Yeah.
right.
Yeah.
So the point about that is you've got a group of people that probably might have said, look, I don't know what's going to happen for the next 5 years or so, but quite frankly, I'd rather do something else. But to do that, I've got to basically possibly sell my business, right?
Yeah.
Or
Yeah.
you get the other problem, which is I've got a great business here, but I'm running out of money. And therefore I need to bring in some other shareholders, or else the whole thing's going to fall apart. Now, do you get involved in any of those sort of situations and trying to help?
Yeah, certainly the latter. I would do my utmost to make introductions to those people who could provide equity or debt funding. I think it's more really a case of the former, though. I just think generally it's been challenging for a while, and it remains challenging in terms of raising finance. There are 1 or 2 banks out there, the challenger banks, who will now provide debt finance, which is helping things along, but it's a slow process.
Do you ever get involved in any transactions where someone from abroad, for example, might be trying to steal our intellectual property on the cheap, but they have the money, but we have the intellect, so to speak? Or have you not come across that issue?
I haven't, but it did happen to a good friend of mine who runs his own digital media intellectual property practice. He's seen that before. I think we've even seen that in cricket, haven't we, with the Indians running off with the T20 concept, which is how we've ended up with 100. But that's a good, yeah. I mean, protection of intellectual property, whilst it's not my specialism, is always vital.
So, in general, you don't think that people as a whole are really anymore, they're not particularly optimistic about the future. In fact, you would say that they're probably very cautious about the outlook. Would that be a fair comment in the clients that you come across?
In my circumstances,
Yes, in
yes.
your, yes.
It wouldn't surprise me if in 3 or 6 months' time the M&A market has taken off again. Whether that's because I was really interested to hear Doug speak about the valuations, whether that's because there is more money out there burning a hole in people's pockets, like there was in 2021 and 2022, because people had that irrational exuberance having sat on their hands through most of 2020, and that drove valuation. And it could be something similar like that again. There could be the green shoots of recovery. I'm not doom and gloom for a particular length of time. We're also seeing more EOTs, which I think you've probably talked about in previous transactions, and they seem to be growing 15-20% a year. I'm a bit of an EOT skeptic, but it seems a lot of sellers are attracted by this no CGT.
Would you like
payable.
to expand on what an EOT is, just in case anybody doesn't know the phrase?
Yes, employee
very
ownership. Yeah, an employee ownership trust. It's where, when the exit is structured, the owner is effectively selling to a newly created employee benefit trust, which is set up for the benefit of those employees who want to have part ownership of the business. What seems to have happened is this model has more or less replaced management buyouts. I can't remember. I think it's been a good 2 or 3 years since I last worked on an MBO, and EOTs seem to have taken over. Trade sales are still there, and the other form of exit, as we all know, exit by way of a listing, that's sort of died to death. I've got one on at the moment, and I'm trying to convince him otherwise. I think he's more ripe for a trade sale, but he's determined to go for a listing on Aquis.
So when you talk to somebody and you tell them that their valuation as a seller is ridiculously high, do you find that most people will say, well, I need to be more in line with the market, or do they disappear and say, well, I'll wait for the valuations to come my way before we do anything else?
A bit of both.
A bit of both.
Yeah. And also a lot of the times, I say we come in quite a long way down the transaction, where there may well have been intense price discussions. The accountants have worked out what the numbers are, and then there's generally what should the multiple be, which is why, what Doug's presentation was about earlier. But there are some reluctant sellers anyway who don't really want to get rid of the business, but there's external reasons why they have to sell, and then they are often your sort of your owner entrepreneur. They find it really difficult post sale of a business. Because they feel as if they're lacking a purpose.
Yes. So if we are in a sort of a blue sky market and transactions are taking place either publicly or privately, often you get a surplus of buyers that can dictate basically the price, and therefore the seller, like selling your house if you have multiple bids for it or whatever. But do you think that is the case, or most of the transactions you are in are sort of already pretty much down the road? There's one buyer, one seller. It's not a competition, so to speak. It's more of a transactional to get the transaction done. And that's why they need you. They're not
current market, yes.
Mm-hmm.
But that could change, and that's changed before. We all know that when you've got several buyers and there's a lot of cash out there, that'll drive up the price.
Mm.
I think that probably explains why the larger transactions aren't happening, because the owners are sat on their hands waiting for valuations to increase.
Well, it's interesting given the psychology in the market, the way that investor confidence is where it is now. And someone reminded me the other day, and this is way before my time, but in 1982, in August, when everybody in the UK went on holiday, suddenly the US stock market took off from nowhere, and everybody came back from holiday. They couldn't understand what had changed, and this led to the technology boom in the States following up from that.
Yeah.
And life changed, and people weren't interested they didn't need to know as much about a company. They just needed to know there was surplus demand for it in order to get interested and involved in it, whether publicly or not. So I don't know whether that's possibly going to change or not. But it's
Well, we'll keep an eye on that very much so.
well, yeah. So I think you just have to watch what's going on. Now, I'm being told, David, that we've run out of time. So I've got to bring this discussion to a close. So thank you very much for your thoughts. And it's been great to have a chat. And Doug, thank you very much too for participating again, because I think this data that you provide and the perspective, and I think the graphical analysis is the way to get the message across very clearly to people what's happening and why things are changing. So to our audience, thank you very much for watching. I hope you found this an interesting forum. If you did, would you please like and subscribe? But we're also interested in getting direct feedback so we can make future forums as interesting as possible. And it only leaves me to say thank you to everybody. Thank you for participating as guests. Thank you for watching. And we look forward to seeing you at our next event. So thank you very much and goodbye.